In this recording, we're going to focus on divisional performance, which is an area of management accounting. Particularly, we're going to look at A'18 question 1, part D, E and F. So we'll have looked at A'18 question 1 already in terms of company valuations and stock market. So 29 marks out of the 58 were strategic finance. The other 29 marks in that particular exam was all divisional performance. And one of the key things I want you to focus on is 12 marks calculations, 17 marks were narrative. So calculations are of course important in SFMA, and that's where you have your cheat sheets. You should have a cheat sheet now for divisional performance. How do I calculate ROCE? How do I calculate residual income? How do I calculate EVA? And your tips from past questions of where you might have made errors and little calculation examples of how you might go across each of them. But 17 marks, there's typically nearly 50-50 narratives and calcs in a lot of them. That's where students let themselves down because they can't apply their knowledge, nor can they explain the significance of the numbers they've just calculated. So bear that in mind, look at your past papers and look at the split of calculation and narrative marks as well. So here, part D, we're asked calculate operating profit, ROC, residual income and EVA for 3 divisions. So you're not getting that many marks per calculation because there's only 12 marks overall. And remember, the examiner is helping you here by telling you to do operating profit. In a lot of exam questions, they just ask you to calculate these 3. You should know that ROC and residual income use operating profit. They don't use net profit after tax. So the examiner is helping you by giving you this as a guiding point. So we'll do that initially. Then outline 4 reasons why it may be inappropriate to rank the performance using the current system. And again, you may wish to refer to part D, i.e. that's telling the examiner, telling you refer to part D in your answer. And then outline 3 issues. So 4 reasons would be 4 by 2 marks is 8. 3 issues, including ethical considerations, that Henry should consider before making a final decision to discontinue EVA. 3 3s are 9. So think of the marking scheme as well. No point giving 2 spectacular answers. The most you'll get there are 6 marks. Have to give 3 specific issues. So as we've looked in other case studies, you'll get your background. This background is Hawk PLC. The managing director, the CEO, is Henry Jones. They're looking to list on the stock exchange, or to list in the main stock exchange. We've dealt with that in previous recordings. But they're also looking, the examiner gives you a separate heading for the management accounting, divisional performance measurement. And they're reviewing their circuit board business, and they have 3 divisions, importantly, which are investment centers. That means they're responsible for revenue, costs, and investment. And the 3 typical financial measures we use are ROC, residual income, and EVA. And what they do then is they give equal weight to each of these 3 measures. That's their current divisional performance measurement system. Minimum required rate of return, 12%. And value creating expenditure has a life of 3 years. You'll need that for your EVA. Company also uses non-financial measures, but again, we're not told explicitly what they are. The Asia division, Frank Brown, is lobbying Henry Jones, who is his brother-in-law, to discontinue the use of EVA, which is related to the last part in our question. He feels it penalises Asia, who is focused on maximising annual profitability. And Henry, the CEO, has heard a rumour that Frank is going to leave to a main rival. And he's seriously considering agreeing to discontinue the use because he knows Frank's departure won't be received well by the board. So that's where your ethical issue and your considerations you have to deal with in the last requirement. So it is important. I'd always read the questions first and then read the text. So then we're going on to the appendix, appendix 2. There's your results for USA, Europe and Asia. And this is typical when you do a lot of divisional performance questions. It's laid out like this. And they give you the capital employed as well. So our first requirement we're going to look at, we'll open up an Excel. We're going to look at what is the operating profit for the 3 divisions. So the examiner in a lot of questions won't ask you to do this. They'll expect you to know to get operating profit, but they're trying to help you along here. So operating profit, you have USA, Europe, Asia. Now what you have to watch for here, and what a lot of students don't, is if you look at here, you're given the revenue, 14,680. You're given the total of the expenses, 9,968. What a lot of students would have just taken one from the other. You had to realise interest and tax is not deducted for operating profit. And that's where some students will get caught out, and that should be a reminder in your cheat sheet. EVA, residual income, and ROC all start at operating profit. So that means for USA, it'll be 14,680. Take off the total, 9,968, but add back your tax and your interest. That's the key thing where students would have made a mistake there. They'd have just seen total revenue minus total expenses, but that's net profit after tax. That is not what operating profit is defined on, and you might get caught in another question where they don't explicitly ask you for operating profit. Same for Europe. It'll be 10,420 minus the total expenses 8,428 plus 240 plus 160. You add back interest and tax, which gets you to 2,400 of operating profit. Just make sure you're happy enough with that. Double check that. 240, 160, 8,428. Sorry, I have the 8 here. 2,392. And Asia, 15,300 minus 8,710 total expenses plus 315, add back 400 of interest and tax. So your operating profit for Asia, 7.3 million. So the Asia division looks to be the most profitable on a traditional operating profit basis, but we want to know then what is ROCE, what is residual income, and then we'll come and we'll look at EVA as well. Remember, there's only 12 marks going overall, so lay it out in a nice tabular format like this and show your workings. So again, I haven't shown my workings there. You'd show them, or you might just say add back interest plus tax to show the examiner what adjustments you're making. Return on capital employed is operating profit over capital. So it's just 5,152 divided by your capital employed, which is given directly, 25 million. And the answer is in percentage, 20.6% for USA. You don't need to go to more than one decimal place. So 20.6%. For Europe, it'll be operating profit over the capital, 12 million, which is 19.9%. So very close. And Asia, 7.3 over 32 million, which is 22%. So you can see here they're all in around the 20% mark. The best performing division is the Asia division. It is the highest ROCE. So one ROCE is typically straightforward. The only thing you'll get cut out on, will you take operating profit? Right, you don't take net profit after tax, and put that as a reminder, a little tip in your cheat sheet. Residual income uses the same figures, but the answer now is in euros instead of percentages. So it's operating profit minus the capital times the required return. So we call that capital times the required return the capital charge. So your residual income, for example, for USA is the operating profit minus the 25 million times the required rate of return, which is 12%. So your answer there is 2,152. Now remember, these are essentially the same measure. ROC and residual income tell you the same thing. What that means is you have 2.1 million operating profit left over after meeting the capital charge. So the capital charge here is you have 25 million euro in capital. To meet the minimum, so 25 million, we'll drop the last 3 zeros. To meet the minimum hurdle rate of 12%, you need to earn profits of 3 million. You've actually earned profits of 5.1 million. That's why that is the residual. So in all these cases, your residual income is going to be positive because your return is in excess of the 12%. If your return ROC was lower than 12%, you would have a negative residual income. So they actually tell you the same thing, just in different ways. Here, the operating profit minus the capital, which is 12 million, times 12%, because they all have the same required rate of return. So that's 952. And the last one then, the Asia division, minus the Asia capital, 32 million, times 12. And they have 3465. So in this case, the ranking is still the same. The Asia division is the best performing. It is the most profit over and above the capital charge. So the ranking there is the exact same. Nothing changes. And that's generally, we can see already why Frank wants to discontinue EVA, because Frank's divisions look the best in ROCE and in residual income, because he's focused on annual profitability and the Asia division. The last one is slightly different now, and this is where the most marks will be going for, is economic value added. That is it's laid out similar. You have NOPAT, net operating profit, minus adjusted capital times the required return. So here you can see EVA in terms of a layout is very similar to residual income, in that you take a profit figure and you take off a capital charge. The only trick is here you have to make adjustments. And you should have a detailed cheat sheet now of all the adjustments for EVA. You start with operating profit and you make adjustments to get to your NOPAT, which is net operating profit after tax. Likewise, you come down, you start with your capital figure and you make adjustments to get your adjusted capital figure. So you're still using the financial figures above, the accounting based figures, but you're adjusting them for accounting limitations. And one of the main adjustments we have is adjusting for what we call value creating expenditure. And this is you're going to have in every question. And we're told in the requirements or in the text of the question, the value creating expenditure here has a life of 3 years. So the proponents of EVA say accounting is incorrect the way it looks at certain expenses. The likes of research and development, the likes of staff training, they're value creating expenditures. They shouldn't be written off to the P&L all this year because it penalises the performance of the managers. So what EVA says is defer some of that expenditure and write it off over its useful life. So similar to what you would do with property, plant and equipment in IAS 16. And the main ones we have, if we look at the list of expenditures, you're going to have, if we work down long, marketing, IT upgrade, staff development, and R&D. So anything to do with training, web development, staff development, marketing or advertising, they're expenses that for the accounting perspective, they're all expensed this year. But the EVA proponents say that's a limitation. These are going to generate value over a number of years because you train staff, you develop new products, so they should be written off over a number of years. So in our case here, we're going to do marketing, we're going to do IT upgrade, we're going to do staff development, and we're going to do R&D. There's typically 3 or 4 in every question. And the trick is here, you don't add back all of them because technically 1/3 should be written off this year. If it's a 3-year life, you write off 1/3 in the P&L of each of the divisions and you defer 2/3 and you write it off next year and the year after. So that's why they tell you at the bottom, the net impact of carry forward EVA is nil. That means there's no previous write-off that you have to bring into the P&L this year, just to make it a bit more simplistic. So this is a quite common adjustment in EVA. So for example, for marketing, of the 990 in USA, you divide by 3 and you add back 2. So you're going to add back 660. It doesn't disappear. You add it back to capital, but we only do that as a single adjustment at the end. The 330 that you aren't adding back, that is 1/3, and that stays in the P&L this year because you write it off over its useful life. The IT upgrade, 825 times 2/3, which is 550. The staff development, 960 times 2/3. So it's quite repetitive once you get into the swing of things. And you have research and development times 2/3. So you're adding back a total there of 2650. And you're going to add that back onto USA's. Just merge and center those so it's obvious where they're coming from. Do a 2-column approach to make it easier. And you're going to add back those to the USA operating profit, which we have from above, is 5152. So you're going to add back 2650. Those don't disappear. You're essentially crediting the P&L by adding them back, reducing expenses, but you're going to credit. So you're debiting. In here, what you're doing is you're adding back to your profits. So you're reducing your expenses, you're adding onto your capital. So your adjusted capital here, you're going to have add backs, and for here it's 2650. Your original capital was 25 million, so you're going to add that back onto your capital for USA. And we'll deal with that in a second. So they don't disappear. Whatever you add back here, you add it onto your capital. So it can't disappear. So there are your expenses. And we'll do the same for Europe and Asia. It's just copy paste, so it's nice and easy. Marketing 750 times 2 over 3. You have 900 times 2 over 3. Staff development 1020 times 2 over 3. And research and development 1050 times 2 over 3. So the totting up there means you're going to add back for Europe 2.4 million. Not dissimilar to the USA. And finally then for Asia, they have marketing 600 times 2 over 3. They have IT upgrade. They've only spent 150, so a lot lower. For the staff development, they've only spent 90. And for the R&D, they've only spent 300. So you can see across the board here, the Asia division is spending a lot less on these value creating expenditures. Because again, we know Frank is focused on maximizing annual profit. That might be something we can link into other requirements as we go through. Because we know we have to talk about Frank and the Asian division at the very end. So we have our value creating expenditure. So for Europe, their capital amount for Europe was 12 million, and you're going to add on 2480. And for Asia, the capital amount was 32 million, and you're going to add on another 760, because they had only a small amount of value creating expenditures. But that only is the first element. That's the net operating profit. We still need to do after tax. So we need a working one here. There are two other adjustments you might come across for EVA, which is your reverse goodwill impairment and your reverse any deferred tax adjustments, on the basis that both of those are accounting adjustments only. They are not economic value. But we don't have either of those there. So you'll have to look at the question pack associated with divisional performance or the chapter in the textbook to see how they're dealt with. But we don't have them here. So what we have now is we have this tax, 300, 240 and 315. But you have to be careful, that's not the tax that's allowed in. So in EVA, if we come down here, working one, tax. NOPAT wants tax on operating profit. No benefit of interest is allowed to be included when calculating EVA. That's an important aspect, is the EVA proponents, they want to know what was the tax bill without any interest expense. So we know the tax bill including interest, because we know interest is tax deductible, USA, Europe and Asia. Your tax bill including interest was 300, 240 and 315. But we also know you had an interest expense, which is tax deductible. But EVA proponents say we don't want that interest expense to reduce your tax bill. That interest expense was 140, 160 and 400. So what they say is you need to adjust your tax. What would the tax have been excluding the interest expense? And naturally, if you understand it from finance, the tax expense then should be higher. Because you had an interest expense, that was reducing your tax bill. And we know the tax rate in the question we're given is 20%. And how you get it is you start with the tax bill and you add back the expense times the tax rate. So your tax bill, if you didn't have a deductible interest expense, would have been 328, 272 and 395. And that's the adjustment you'll always have to make if the tax is given to you already. If the tax figure is not given to you already, then all you do is multiply the operating profit times the tax rate. But the fact they've computed tax already, then you have to adjust it for the interest expense, which is not allowed to be included when you're calculating tax for EVA. Quite a niche one, but there's only 4 adjustments that come up for EVA. Value creating expenditure, goodwill impairment, deferred tax, and this one, which is probably conceptually the hardest one. So it's just about practice. So we can take those then, 328 minus 328 for tax, which gets us a NOPAT of 2322. The next one, we have minus 272, which gets us a NOPAT after we do the adjustments. Be careful there, I must add them all together, of 7474. Here we have operating profit plus my add backs less my tax of 46 even. And your tax adjusted is 395 for Asia. And your operating profit plus your add backs less your tax is 7670. What I'm trying to show to you is laid out neatly. Give the examiner reason to give you the marks. Don't have it messy. And if you're doing workings, cross-reference them in. So we now have our NOPAT. The tax adjustment has no impact on adjusted capital. So your adjusted capital here is just doing the add backs. Notice here I don't make work for myself. I do one add back. Sum them up and do a single add back. Don't do 660 plus 550 plus 640. You're duplicating your effort. As long as the examiner can see where the 2650 is coming from, you'll get your marks. So that's your adjusted capital for Asia, for Europe, and for USA, Europe, and Asia. And now once you have that done, the EVA just falls out. It is your NOPAT minus adjusted capital times the 12% doesn't change. So the answer is still in euros, like residual income. Did you earn above or below 12%? In this case, they earned above. They created economic wealth. Here, 46 minus 14, 4 times 12%. They earned above. And the last one then, the EVA for Asia, will be 7670 minus 332 times 12%. So look at what's happened now. The Asia division is no longer the best performing. It is now the second best performing. The best performing division is USA when you look at EVA. And a good student, pause it now. See, can you go back and figure out why is that happening? Why has the ranking changed? And what you hopefully will see is USA is spending a lot of money on these value creating expenditures. 990, 960 on staff development, 1200 on R&D, 800 on IT upgrade, as is Europe. Who isn't spending money is Asia. They're only spending 600 on marketing. They're only spending 150 on IT upgrade. They're only spending 300 on R&D. They're spending a tenth, 90 on staff development compared to the other divisions. So you can see that is why Frank wants to drop EVA, because they want to focus on the accounting based ones which maximize annual profitability. The problem with that is if you're not spending money on staff development, you may not have the same profits in the future. If you're not spending money on R&D, you may not have the future product pipeline. So it's a very short-term focused measures, and we can see why the Asia division manager is promoting that or lobbying for that, because they're coming off worse. They're performing poorly. They're still making a significant EVA, but they're not ranking first. Right? There's a change based on the overall measure. So that's your first one, is lay it out neatly like that and get your marks. Right? So what your time in there, that was 12 marks, about 24 minutes. Your next part then was 8 marks, outline 4 reasons why it may be inappropriate to rank 27 performance using the current system. You may wish to refer to your results in part D. Right? So again, that means refer back. So first thing we said, these are all financial measures. So it's a very narrow view of performance. That's one reason it may be inappropriate to rank them. The second reason it might be inappropriate is 2 of the 3, and remember they all get equal weight, so 66% of the weight is going towards short-term measures. And you could reference there explicitly the focus of the Asia department. They look great for ROCE and they look great for residual income. Whereas in fact, the main reason for that is they're not spending enough money on marketing. They're not spending enough money on staff development. So there's an unusual, what we call a dysfunctional incentive not to spend money on development costs because it will damage initial profitability. So they're all financial. They're heavy weighting towards short-term measures, which is another key issue. The other key thing, which is a problem here, is you're treating them all the same. Each of them have a 12% required rate of return. There's no guarantee that that's the right rate of return for each of them, because the Europe division could be riskier than the US, or the Asia division could be riskier as well. So you should have a required rate of return specific to each division. Otherwise, it's somewhat meaningless, and you're trying to take a one-size-fits-all approach, which may not be suitable to the business overall. So that's another point you could make in terms of it not being suitable. So what you can see there is all those points are specific. You're saying it's too financially focused, too much heavily weighted towards short-term measures, doesn't account for the differences between the geographical regions in terms of risk and the different measures they have. And you should have more non-financial measures in there to allow a better ranking to happen. Because otherwise, essentially two of those measures are the same. So there's not much variety. You're still heavily focused on accounting figures, which are easily manipulated. Right? But the key point there is you have 4 reasons, 4 solid bullet points, and maybe 1 or 2 sentences each. Because 8 marks is a significant amount. You can't just give a couple of little words and hope to get your full marks. 3 issues then, including ethics. So again, you have to give 1 at least ethical point that Henry Jones should consider prior to make a final decision of discontinuing the use of EVA. And this is coming from this last paragraph here, where you're told Henry's brother-in-law, Frank Brown, the Asian manager, is lobbying to discontinue the use of EVA because he wants to focus on maximizing annual profitability. And Henry's heard a rumor that Frank Brown might leave. And again, he's seriously considering agreeing to this because he knows it won't be received well by the majority board of directors. So one of the first things here is you have to consider, well, if you agree to this, you're going to be left with 2 short-term measures. We know already, we've established the main reason Frank Brown wants to discontinue EVA is he's not spending money on development costs, upgrading IT, staff development, R&D. So there's an unusual incentive here. That's why they're not doing EVA. It's for his self-interest, not the overall group. So from a Hawke perspective, Henry has a duty to make sure he's working on behalf of the shareholders, not just Frank Brown or the Asia division. So from an ethical perspective, the point you had to make here was that's why you're told he was a brother-in-law. That there's a personal relationship here and there's a conflict between your professional relationship as a CEO of an entity, Hawke, and your personal relationship between Frank Brown. So you have to manage that and say, well, he may be putting pressure on you, and essentially he's painting you into a corner by perhaps even spreading a rumor that he will leave. But you have to work on behalf of the overall business. This would not be good for the business overall. That if you remove this EVA, that leaves you with very narrow performance measures, and it also means you set a bad precedent that people can put pressure on you and you will let them off in terms of what they want. So in terms of some key feedback there, what would we say? The ethics. First thing is, would leave with only 2 essentially the same short-term measures. So it doesn't make sense. If you remove EVA, you're just going to be left with ROC and residual income, which are the same. They're 2 short-term. We know why Frank wants this. Not a good reason. Neglecting spending on development. Frank is neglecting spending money on development because he wants to maximize annual profits in the short term. That might be fine to maximize Frank's bonus now, but in the long term, that's going to do damage. We'll set a bad and difficult precedent. So think about it from the CEO's perspective. If you request to this particular request from one divisional manager, what's to say the Europe manager won't come and look for a different performance measure next time? So it sets a very difficult precedent that you don't want to have to deal with. And the ethics then is the personal versus professional role. How do you deal with that? How do you not damage your personal relationship or let it to influence? CEO of Hawke must act in company's best interest. So you can't be too heavily influenced by your personal relationship as being a brother-in-law. You have a role as CEO and your chairman. Henry Jones is chairman as well. You have to make sure that you understand your responsibilities to the company and to the shareholders of that company. So it's not an easy one. Now, they don't ask you for recommendation. Sometimes they do. In this requirement, the wording, just be careful, because that's where the marks go for. 3 issues that they should consider. Not give a recommendation, but we've given you 4 there. Now, you could have come up with other ones as well, but just list them down, give 1 or 2 sentences. I've just kind of given you at a high level. And the suggested solution will go into a bit more detail then if you wanted to have a read through those as well. But the key thing we want to take away from here is there was 17 marks going for narrative. And that is not generic narrative. It is applied specifically to the facts of the case. And then 12 marks for calculations. So that is looking at the management accounting area of divisional performance, autumn 18, question 1 for 29 marks.